5 a.m. in New York City. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. Trade threat. President Trump vows a 25% tariff on South Korean goods. This as other nations seek trade partnership to diversify away from the United States. Shifting tone. Trump's border czar set to meet with Minneapolis Mayor Jacob Frey under mounting pressure to change course on his immigration crackdown. And earnings ramp as a global stock marching towards fresh record highs continue. All right, let's look at these futures. They are pointed higher once again today. We did see some gains yesterday. We were off our highs at the end of the session. But year to date, we're still up plenty. We're up 1.5% on the S&P 500 and more than that, 1.8% on the NASDAQ 100. So all calm on the futures front right here as we continue with the earnings ramp. All calm in the bond market as well. If we look there, yields continue to stay around the 481 on the 30-year yield, 422 on the 10-year yield, just a basis point higher, and 358.32 sticking to this level. Some kind of signal to the Federal Reserve starting its meeting that, all is calm right here. Keep things here for right now. Let's take a look at some of the other volatile assets that were moving yesterday. So we're still below 154 on the yen. Looks like nothing too much has changed there overnight. Gold still at $5,100 an ounce. That ramp continues. And natural gas futures have calmed ever so slightly. That front month contract rolls off tomorrow, Wednesday. So there's a little bit of illiquidity, but also it is just down from the really elevated levels that we had seen above 7. Do expect that might ramp up again, though, because we're seeing another winter storm possibly coming through, at least in the United States. All right, with that volatility to watch for the next hour, let's get to some individual movers now. For that, we go to London and Chloe Melly.
Good morning, Bonnie. Insurers are in the red today as the U.S. proposed roughly flat rates for Medicare insurers next year. And this came as a big disappointment to investors and also as a big surprise, given it was thought that the current administration would be much more favorable for private Medicare plans than the previous ones. And therefore, we're seeing a big downward moves across that sector this morning, and Humana in particular down more than 12%. Moving on to Micron, which is in the green after saying that it will invest $24 billion in Singapore over the next decade, and this is to expand its manufacturing capabilities to ease the memory chip shortage, which of course is in really high demand because of the AI boom. And therefore we are up more than 4% in pre-market trading for Micron. And finally, Salesforce is also in the green after being awarded a $5.6 billion contract from the US Army. It will provide some of these cloud technologies to the Department of War, and we are seeing the company up about 2% this morning on the back of that contract.
Chloe, thank you so much. That is Chloe Melly there in London. She'll be back later in the hour. And also coming up this hour, we're going to be speaking to Austrian National Bank Governor Martin Kocher. And later this hour, Katrina Dudley of Franklin Templeton joins as stocks look for a second straight day of gains. But first, 2 decades in the making, the European Union and India have reached a trade deal. European Commission President Ursula von der Leyen is calling it, quote, the mother of all deals. She added on a post on X that the two countries have created a free trade zone of 2 billion people, with both sides set to benefit. Joining us now from Brussels is Bloomberg's Oliver Crook. So, Oliver, this trade deal, 2 decades in the making, but it might not even have been necessary if there wasn't a whole trade realignment taking place in the first place. What's in this deal?
Yeah, absolutely, Vonnie. I mean, conspicuously, it also comes a couple of weeks after another trade deal that the EU negotiated with Latin America, which had been in the works for 25 years. So, yeah, it's no sort of accident these things are all happening now, after a year of sort of Trump tariff roller coasters. But the India trade deal, this is something that Ursula von der Leyen and the European Union really want to take a victory lap on, because India is notoriously one of the nations with the highest trade barriers across the world. And what the EU is now saying is that their companies will have preferential access to that market. So I'll give you just the top line of kind of what we can expect here. They say that it will eliminate or reduce tariffs on 96.6% of EU goods that are exported to India. The EU will also eliminate in return or reduce tariffs on 99.5% of goods that go into the EU. Now, we should say that those figures are a little bit misleading, because reducing tariffs from 150% to, say, 75% is not necessarily eliminating them, though it is certainly a sort of large step forward for the European Union. And the European Union say they would like to double their trade, double their exports to India over the next 5 years. And just to give you flavor of some of the things that are contained here, there's really things for every European country. So, for example, for the Germans, car tariffs will go from 110%. That'll come down to as low as 10%. You get wine, something for France, from 150% down to 75%, eventually down to 20%. Olive oil for Italy down from 45% to 0%. Now, a couple of notes on all of that. This is still a deal that needs to go through the European Council. It still needs to go through European Parliament and some legal opinions. And this is something also that with these tariffs, it's not just going to go into effect on day one. This will be tiered over a number of different years, sometimes 5 years, sometimes 10 years. But the broad strokes here, Vonnie, is that in this sort of global realignment that we've seen from Donald Trump, we're starting to see what the consequence of that is, and that is pushing people together, people that would not necessarily, as you alluded to earlier, necessarily have this trading relationship were it not for Donald Trump.
Speaking of which, the UK Prime Minister Keir Starmer is visiting Beijing this week. What are his intentions?
Yeah, absolutely. And I think this is sort of very, very interesting. It comes in the week of Mark Carney striking that sort of trade deal, not necessarily a free trade agreement with China, which obviously got a lot of scrutiny from the Trump administration, a lot of criticism. You see the UK doing something similar. We spoke to Keir Starmer overnight about kind of what his intentions are there. And he was basically saying that it's a false choice to say that you have to choose between the United States and between the United States and China. But I think as we see with Canada, as we see with the United Kingdom, as we see with the EU, who's choosing to trade with Latin America and India, this is all about sort of diversifying these markets, because at the end of the day, once the United States has sort of proved itself to be unreliable, that's really only something you can do once. And the moment that that begins, all of these countries are going to look to diversify away from the United States. For the Europeans, they're also looking to diversify away from China, and they're going to try to find all of these different markets. For what I think will be very interesting, Vonnie, is that as this sort of continues to go forward, what is the Trump reaction going to be, as if the Trump administration feels that they're losing their sway on these trading partners because eventually they're diversifying away from the U.S. That could create quite a combustible situation if the American president feels that he's losing control and tries to reassert it as time goes on.
Well, so far it's not stopping President Trump issuing the threats. The latest one on South Korea, another 25%, because it hasn't been quick enough to ratify the trade deal and to get moving on investment, right, Ollie?
Yeah, that's right. I mean, so they were going from about 15%, which is the agreement that they've got signed, and he's very upset that basically the parliament has not yet ratified it. So he's now saying, OK, we're going to kick up tariffs to 25%. Now, if you look at the session for the Kospi here, I've got it here in front of me. I mean, that sent shares in Korea down basically 1%, but that session closes up almost 3% on the day. So I think that it's fair to say that for the markets, they're sort of dismissing this threat. We actually crunched the numbers, our trade team over at Bloomberg, and looked at only 27% of all the tariff threats that Trump has began since the beginning of 2024, when he came into office, or when he was elected. Only 27% of those threats have actually gone into effect.
Yeah, and yet they don't seem to be losing their potency. Oliver, thank you so much. Chief European Correspondent Oliver Crook. In Minneapolis, U.S. Border Patrol Commander Greg Bovino is set to be leaving the city over the recent killing of 2 U.S. citizens by federal agents. This as President Trump signals a strategy shift in his deportation drive. Joining us now from Washington is Jonathan Tamari of Bloomberg Government. So, you could ask what's prompting this shift, Jonathan. It should be the obvious, but maybe it isn't. Maybe it's sagging poll numbers. Maybe it's just the difficulty in continuing in Minneapolis with, his commanders there perhaps overstepping.
Yeah, I think it's a combination of all these things. I think these 2 shootings that we've seen have driven down what were already bad poll numbers for the president. And immigration has traditionally been one of the strongest points for President Trump for Republicans. It's one of the first things he talked about when he entered politics, and it's been really powering to him. And when you look at the polls now, there's significant disapproval of his handling of immigration, significant disapproval of Immigrations and Customs Enforcement, which is kind of the face of this crackdown, although not the only agency involved. And I think even people in the White House realize that the handling of this second shooting and many of the false statements that were made over the weekend is just disastrous, if not morally, certainly politically. And we're seeing a change in tone, which is a very rare thing for Trump to do.
Obviously, the human element is paramount, but beyond that, there is a government funding bill. I mean, does that take away questions of whether we'll have a partial government shutdown now or not, if indeed, something changes, at least in the tone, if not in the actual execution with ICE?
I think it's still going to be a very big problem. Democrats are really furious about the way this has been handled, and there's a number of Republicans who are also very concerned about the way the investigation is unfolding, and they're calling for a truly independent investigation as opposed to what we've seen so far, where the Department of Homeland Security is essentially investigating itself. So I think Democrats are going to make some demands about conduct of these immigration raids, for the rules of engagement, the rules around how ICE conducts itself. We'll see senators are coming back to town this evening, so that'll be a better indicator. But I think Democrats are going to draw a hard line on this one after what we've seen.
All right, and borders are Tom Homan in Minnesota, Homeland Security Secretary Kristi Noem's rival, of course. Jonathan, thank you so much. Jonathan Tamari of Bloomberg Government in Washington. Now to other top stories trending on the terminal this morning. US airlines are still paring back flights as a deep freeze hampers the restart of operations at some major hubs. Delta says services at its hubs in Boston and JFK are affected. American Airlines has axed about 500 mainline and regional services. Airlines bracing for further disruptions as another Arctic blast looms later this week. Goldman Sachs CEO David Solomon says he sees a slower trajectory for talent growth this year, even as he makes an upbeat call on global markets. He spoke with Bloomberg TV's Stephen Engel from the Goldman Sachs Global Macro Conference in Hong Kong.
It's probably a little bit more constrained in 26 because we see opportunities for efficiency and we're trying to deploy those. But ultimately, we've also said those efficiency opportunities give us more of an opportunity to invest in parts of our business where we can scale growth, and some of that growth scales with additional headcount. I point to our wealth management business, which scales with people all over the world.
And Puma shares are surging after news that China's biggest athletic apparel seller, Anta Sports, plans to buy a 29% stake in the German brand. The €1.5 billion deal will make Anta Sports the largest Puma shareholder. Coming up, an exclusive interview with ECB Governing Council member Martin Kocher. That's next. This is Bloomberg. This is Bloomberg Brief. I'm Bonnie Quinn in New York. Let's get right now to our exclusive interview with ECB Governing Council member Martin Kocher. Here's Bloomberg Daybreak Europe anchor Lizzie Burden. Lizzie.
Bonnie, thank you so much. Well, it's great to speak to the Governor of the Austrian National Bank ahead of the ECB decision next week. Governor, thank you for stopping by in London.
Thanks for having me.
You and your colleagues at the ECB have talked a lot about how you're in a good place, but the geopolitical backdrop doesn't seem to be in a good place anymore. Of course, you had President Trump's tariff threats over Greenland. He walked them back, of course, but has all of that changed your economic outlook?
So we've received our last projection in a large exercise in December, and lots of things happened in terms of trade conflicts, in terms of other geopolitical developments since December. But we knew already in December that the uncertainty levels that we are seeing geoeconomically, geopolitically are high. So it's important to have full optionality. The monetary policy has to be able to react to any kind of risks manifesting themselves quickly and decisively. So it means having this full optionality is an asset, and we agreed that we want to have this full optionality in any direction.
But we were talking about how it feels like a year has happened in a month already. Do you think that household and business confidence can withstand this lingering trade uncertainty? Will it dent confidence at all?
What we've seen in December, and I think it hasn't changed, is that the sentiment indicators within the euro area are slightly biased upwards. We see modest growth projections. We see inflation projections in line with our 2% target. So that means, and that's the reason why it has been called being in a good place, but it means, of course, not that we want to be there for all time. It means conditionally on what we are seeing, conditionally on the risk environment, this is where we want to be, but we want to be able to react quickly to anything that happens.
Well, yeah, the Eurozone economy was pretty resilient in 2025. Do you not perhaps fear that the tariff impact is in the mail? It's coming at some stage in 2026?
You're absolutely right. Some of the experts predicted that there will be strong impacts on the euro economy in 2025 already. You have to take into account that some of the tariff threats have not been implemented. Some of the rules have been relaxed a bit, but uncertainty is still very high, and we've seen that last week with additional tariff threats. So Yes, indeed, we have to be careful. There might be some repercussions. There might be effects on the development of the European economy coming from the very unstable international environment, especially with regard to the trade environment. But we have seen today the trade agreement being concluded between India and the European Union. So there's a clear strategy to diversify to make sure to be more resilient as a region.
Does that move the needle for growth for the Eurozone economy?
We'll see what's going to happen. But we are at a projection very above 1% for the euro economy. It is modest growth, as I said. Hopefully, those risks that we have identified as being tilted towards the upwards, the German stimulus, the savings rate that is very high and that could reduce more quickly than expected, that those chances for economic growth are manifest themselves during the next couple of months, and then we might see even larger growth. But of course, the downside risks that we're discussing all the time, they are quite substantial, and we need a more certain outlook. We need more calm to make sure that the international economic development is better.
Well, yeah, Governor, when you look at inflation, the December print was actually shy of the ECB's target, and it's predicted to be slow again in the next reading. But then core inflation pretty stubborn. What for you explains that stickiness?
Difficult to say. We're looking at different things and monitoring, especially the wage development that matters a lot. We're monitoring import prices. There's a couple of aspects that influence prices directly or indirectly at the moment. But as long as we are having or seeing modest diversions from the targets, I think we are fine. But if there is, in any direction, a clearer movement and we get more and more data in that direction, then it's important to monitor it closely and be able to respond.
Well, yeah, I know you tend towards the hawkish persuasion, but if that undershooting became persistent, at what point would it start worrying you?
So the outlook that we have, there was the large projection exercise in December, is that we are returning to 2% and slightly undershoot this year, next year 1.8, 1.9. So this is really, really modest. I think what you need is a strong undershooting or overshooting. And a narrative, an explanation why this is the case. At the moment, these are just small diversions from our targets.
How does the dollar weakness and euro strength on the flip side feed into your outlook for inflation?
So the exchange rate, of course, matters. Europe is a quite open continent. That means exchange rates matter, especially when it comes to the trading relationships, but also when it comes, of course, to prices, competitiveness. So all these things matter. It's a bit unclear what it means, but we've seen some appreciation of the euro over the last year. That was actually quite substantial when you compare it over the last year. On the other hand, if you compare it to the span of exchange rates we have experienced since the creation of the euro, then we are very much in the middle. So what we have to monitor now in the next couple of weeks and months is whether this appreciation continues and whether it perhaps even accelerates. But we don't see that at the moment. But of course, events that have been happening over the last couple of days, they contribute to some concern. So clearly a thing to monitor in my view.
But one thing that could change, will be changing, is who's sitting in the chair at the Fed. Of course, Jerome Powell's set to be replaced. If that person is particularly dovish, I wonder where it leaves the ECB. Because one of your colleagues at the Bank of England, Megan Green, has been saying that the impact of loosening financial conditions would outweigh the stronger currency impact on imports. So if you do have a dovish Fed, would that accelerate ECB rate hikes?
First of all, I think it's important to talk about central bank independence, and it's clear that it is in the interest of the public to have an independent central bank that is able to respond quickly. And when we talk about the exact policy stance that the central bank has, then of course we're not reacting to the policy stance itself, but of course, a completely different policy stance by the Fed might have spillover effects onto the inflation outlook in the euro area. And it's a bit unclear what we could expect if that is the case. There is, of course, first of all, effects on the economic development, but there's also potential effects if the stance is too loose on financial stability, perhaps. So lots of things, but it's a bit early, I think, to judge. We'll see when and who is appointed.
So in the nearer term, markets are still pricing a small risk that the ECB cuts this year, but further out they're looking at a bigger pricing of hikes down the line. Governor, does that tally with your view?
At the moment, we're in a good place. That is exactly what has been surprising to a certain extent, given the uncertain environment, that we have been seeing quite some stable inflation outlooks. That's the main target. But I think the risks that we are seeing in both directions make it unlikely that over a very long time we are able to stay where we are. That means full optionality is important, as I said, but it's difficult to say if it happens that we stay at the current rate and the economic development remains calm and some of the risks reduce. Then I'm happy, but we have to be prepared for any changes.
How much worse would things have to get for you to back another cut?
I mean, if clearly the inflation outlook is going down, so if we are going clearly below 1.8%, which is the current outlook, then we have to discuss a cut. But it's equally likely, I would say, so the risks are more balanced now that we see a development where inflation outlooks are adjusted upwards, and then we have to think of a hike. But at the moment, we are doing fine.
Well, some of your colleagues have gone as far as to discount the idea of a hike this year. Would you go as far as that?
We have agreed on a meeting-by-meeting approach and a data-dependent approach, and that means you have to be open to anything that is necessary at that moment, but being very well prepared. So I would not exclude anything at the moment.
A message I'm sure that President Lagarde will be echoing in Frankfurt next week. Great to have you with us in London. Thank you so much.
Thanks a lot.
Bonnie, that was Martin Kocher, the Governor of the Austrian National Bank and member of the ECB's Governing Council. Thank you.
Fantastic interview, Lizzie. Thank you very much. That's Bloomberg's Lizzie Burden there. Time now for your front page news. First up on the Washington Post, House Democrats set to open an investigation into Homeland Security Secretary Kristi Noem as early as next week, laying the groundwork for a push to impeach her. The Post says Democrats plan to conduct their investigation without Republicans. Now, they do concede they're unlikely to remove Noem in the short term, but believe launching an investigation will signal they are taking deaths in Minnesota seriously. Next up, the Wall Street Journal is reporting tax filing season will produce a cash surge around $100 billion, higher than last year's $329 billion total. And it's engineered to boost Republicans' sagging approval ahead of the midterms. The Journal says the plan has little guarantee of success. Republicans need, for example, the IRS to issue refunds efficiently, and they need to make voters know why they're getting more money. And finally, the Financial Times reporting the administration has indicated to Ukraine that U.S. security guarantees are contingent on Kyiv first agreeing a peace deal. That deal would likely involve ceding the Donbass to Russia. The FT says Ukrainian and European officials describe the U.S. stance as an attempt to strong-arm Kyiv into making painful territorial concessions. All right, let's take a look at these markets because futures are pointed higher, particularly Nasdaq 100 futures after a day of gains yesterday. Now, the Bloomberg Dollar Index is bouncing around its lows. We have Paul Donovan of UBS saying today as trade stagnates and maybe even starts retreating, reserve status for the US dollar actually becomes less important. And we might see international investors flouting out of dollar assets in any kind of dramatic exit. But we might see them less interested in accumulating additional dollar holdings. So that's a little nuance there to the debasement trade. The 10-year yield not really going anywhere, just up a basis point to 4.22. We have silver bouncing around the place. It gave up some of its gains and now it's gaining again. It's very close to its high above 114 an ounce, right now about 112 an ounce, and gold still about $5,100. Coming up, tech leaders will catch up with Katrina Dudley of Franklin Templeton on the AI investment trade. It's 5:30 a.m. in New York City. Good morning, I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. Trade threat. President Trump vowing a 25% tariff on South Korean goods this time. This as other nations seek trade partnership to diversify away from the United States. Shifting tone, Trump's borders are set to meet with Minneapolis Mayor Jacob Frey under mounting pressure to change course on the immigration crackdown. And earnings ramp up as global stocks march towards fresh records. And to that end, we can see it happening once again today with futures pointed higher and gaining ground now. Look at those NASDAQ 100 futures just rolling away with things. Now, Russell 2000 futures pointing to gains, but that index, while it outperformed the others at the beginning of the year, taking a little bit of a back seat, particularly to international stocks in the last few sessions. Bonds-wise, we're not seeing too much movement. Of course, the big event is the FOMC decision tomorrow. So, of course, bonds will be waiting on anything that comes out of that. Not that we're expecting any kind of a cut or anything like that, but that two-year yield firmly stuck to 358.53. And then in terms of other assets on the move, well, obviously that volatility continues. The yen did top 154 earlier, but it's back below that now, so it's stabilizing to an extent. Gold also stabilizing, albeit at highs. We're very close to 5,100. And natural gas futures, that front month contract coming off, it rolls off tomorrow, so there's a little bit of illiquidity there. And as we know, the second and third month contracts were not priced to that extent whatsoever. Silver is an interesting one today. It's bouncing around the place. It had come off its highs, getting right back to those highs now, and as we know, it's well above $100 an ounce. Let's get to some individual movers to watch now in the early hours. Here's Chloe Melly.
Good morning, Vonnie. Insurers are in the red this morning after the U.S. proposed roughly flat rates for Medicare insurers in 2027. So this came as a big surprise, given that the current administration was expected to be much more favorable to that insurance industry, and also came as quite a big disappointment for investors, given that some analysts had expected an increase of as high as 6%. And so we are seeing that weakness, that disappointment reflected in those shares in that sector today. Moving on to Micron, which is in the green this morning, after saying it will invest $24 billion in Singapore over the next decade. It is expanding its manufacturing capabilities so that it can actually answer to this global memory chip shortage, which is, of course, due to the AI boom. And so we are up this morning on the back of this Singapore investment. And finally, Salesforce is also in the green after being awarded a $5.6 billion contract with the U.S. Army. And the U.S. Army will be using those cloud technologies from Salesforce to simplify the contracting process and reduce procurement timelines as well. And so this big contract is being rewarded by the market this morning, and we are up a little bit over 2% for Salesforce in pre-market trading this morning.
Indeed, we are. Chloe, thank you so much. That is Chloe Melly there in London. Global stocks climbing towards fresh records. U.S. stocks looking at 2 straight days of gains now after back-to-back weekly losses for the S&P 500. Joining us now is Katrina Dudley, Senior Investment Strategist at Franklin Templeton. Thrilled to have you in studio. Katrina, just a broad question first. What is the health of this market? And if we look at, say, the rotation trade, which was peeking its head up at the beginning of the year, or the debasement trade, which was also there, where do they stand?
So if I take a look at the health of the market, what we look at is breadth, and we've talked about breadth, and I think last year we were wrong. We thought that the market would broaden out, and really you saw a lot of the returns to the Mag 7, and that concentration level is at such high levels that we now think we're set up for this broadening trade. If we look across all of the GICS sectors and we look at our 2-year forward earnings forecast, it's positive across all of those sectors. And as you know, it's earnings growth that drives market. It's not so much valuations. That is actually what happened in 2025. It was the growth in earnings that resulted in the growth in the market. And we think with this broad-based growth in earnings across all of the markets, we're going to continue to see this positive narrative.
Well, so earnings season so far, and it's just starting, has been very nice, right? On top of a pretty decent earnings season last time around as well. So I'm curious, what then causes the market to be fragile? Because at the end of last year, suddenly everybody was worried about a bubble and we saw days of massive volatility.
Yeah, so you had last year and even the years prior, which kind of this recession, no recession, and where are we going? And I think that narrative has really tampered down. So people are very much in the camp of this is stable, it's good economic growth. We've got a lot of good trends that are supporting the market. We have the AI, CapEx, we have AI productivity. There's some of the things which I think are going to be such drivers of earnings and such drivers of the market going forward. So I do think we have a positive narrative. It is no longer just there's no recession camp, which is going to support the market, which is that prior positive narrative. Now I think you have some really tangible drivers of earnings going forward.
Right, so you think breadth is going to be a lot more healthy,
Yes.
but you obviously think that the AI trade isn't done yet. And I want to point to something that you've written. You say, across our equity and fixed income teams, AI-driven investment is consistently viewed as a durable support to activity, both US and global, even as non-AI pockets of the economy soften. How does that then overlay on your investment thesis that you just outlined?
So whereabouts are we looking at AI? AI is now actually impacting multiple sectors. I look at us in financial services. We're a traditional regulated business, but we're actually benefiting from the productivity side of AI. So that AI trade is actually migrating into various parts of the economy, but it's not migrating everywhere. And it's also not migrating evenly. There are some early adopters and some people that are really latching onto AI. They're forward thinking, and they're the companies that we think you should really be investing in, not just within your traditional technology sector, but across a broader spectrum. But there are a number of companies that are going to be left behind, the AI doubters, and that's where you've got to be very wary.
Well, so how do you identify them? Is it something to do with the neo-cloud nature of certain companies? Is it to do with how companies just generally in the economy are using AI? What would be the criteria?
So what it is actually just on the boots, feet on the ground research, talking to companies and listening and hearing where they are in terms of their AI journey. So you can look, and it's not necessarily the places you would automatically go to, but you could look for a materials company, for example, investing in AI to help them with the leaching process and getting more productivity out of the same amount of rock that they're taking out of the ground. And that would be an indicator of a company that's forward on the AI curve. That's probably an investment that they've been talking about for a number of years, because these AI investments are they're long-tailed investment, and you're now starting to see that productivity starting to come through. But it is really understanding companies, understanding what they're doing and how it flows through to their business model and where they're going to see those benefits.
Now, you mentioned that this is paramount to your fixed income teams as well. How are they using the AI narrative to decide what they invest in? Is it AI debt that they're investing in, or just debt of companies that use it well?
It's more about the growth narrative, and that's where we're seeing it show up in the fixed income teams, because from a fixed income perspective, this idea of how sustainable is economic growth. We've come off a year of very strong growth. We're looking at our growth forecast. We're at 2.5 for 2026. I think the market's around 2.3, so we're slightly above. So we're still continuing to be optimistic on a growth front, and that's where this AI and the CapEx narrative shows up in our fixed income teams.
Katrina, is there any possibility that we'll get some kind of a surprise tomorrow? And I don't even just mean a cut or something. I mean maybe something that's in the commentary or,
No, we really think that if I look at the betting markets, and that's, just one data point that we do, the market's not expecting anything tomorrow. So the market is expecting more of the same. We've been in the camp that, it's going to be higher for longer. So even if we have cuts in 2026, we think that they're going to come in the latter part of the year. We're not optimistic about them coming in this forward part. So I think you're going to see these higher rates stick around. And I think the Fed narrative is going to be supportive of that. If you look at wage growth, wage growth pressure has started to abate. So so that's another positive for them because that lessens that unemployment narrative. We were concerned that we would start to see some job losses attributable to things such as AI, and I think that with that lower wage pressure, you're likely to see the Fed just sit still here.
You talked in your note about internationally and growth holding up and productivity and so on. Where are you looking in particular internationally this year? I mean, we saw a huge run up in China, for example. We also have the yen story and the idea that maybe even a huge investment pension fund might be thinking about pulling out of US Treasuries, which indicates that there's going to be plenty going on between the US and Japan in the next year.
Yeah, I think you mentioned it. I mean, the US has been a place where a lot of incremental investment dollars have gone, and I think that we're probably closer to the end of that allocation. But that doesn't mean that the US goes down. It just means we're not a source of incremental fund flows. If I look at Japan, it has been a long story there in terms of improvements in the market, improvement in the market structure, a lot of change in how companies are thinking about returning capital to shareholders. So I think that you continue to have that long tail of the story, and then you have those incremental things such as a shift of more money into equities within that domestic market. The other parts is you're talking about emerging markets. It's an area where our EM teams are seeing a ton of opportunities. China is obviously a big part, but there are a lot of other emerging markets that we just think are well set up if we look at how they've handled COVID. And I know we're 6 years after COVID, but still, what they did during that situation, I think, has set a number of these economies up well and to be opportunities. I think you can really. If I wanted to pick one, I would probably go somewhere like India, where you've got a lot of good market structure and a lot of opportunities there.
All right, Katrina, so much content. Thank you so much for visiting us in studio. That is Katrina Dudley of Franklin Templeton. Now to a Bloomberg exclusive. Goldman Sachs CEO David Solomon seeing a slower trajectory for talent growth this year. He spoke with Bloomberg's Stephen Engel at the Goldman Sachs Global Macro Conference in Hong Kong. Take a listen.
The environment's very constructive, for our business, particularly our banking and markets business. We highlighted in our fourth quarter earnings, our year-end earnings, that our backlog was again at another, significantly high level, and it moved quite positively. I think it's going to be a very constructive year for M&A activity. Could be one of the best years, if not the best year ever for M&A activity. I think CEOs feel unleashed to really invest, drive growth in their businesses. It's a better regulatory environment. They're asking big questions about what the art of the possible is. That's very different from where we were 4 years ago, where the answer to any question was no. Now the answer to any question is yes, maybe, and so CEOs are looking forward. That's a very, very constructive environment for our business.
The stock market here regaining the IPO crown last year, and essentially on the back of all these IPOs in the tech sector. A lot of them, really, the big gainers have been the infrastructure and the not necessarily the applications or the large language models. They've been essentially the hardware players, the chips and the like. Do you see a sustainability of this pipeline from China of AI?
If the environment continues to be constructive the way it is now, yes, I think it'll be a very good year for IPOs over here too. I think there's a lot of pent-up capital markets activity because we really, coming out of the pandemic, we kind of shut down capital markets for a period of time. You got a more conducive regulatory environment. You've got a good detente in U.S.-China with a constructive setup in 2024 for more constructive dialogue. I think all that's conducive for more IPO activity here in Hong Kong. And I think you're going to see more IPO activity in the U.S. and in Europe. So it's a pretty constructive setup. Now, of course, if there was a big exogenous event, you can slow it down. But I don't think that's the base case. But that doesn't mean we won't have some speed bumps along the way this year.
I think Wall Street shed about 10,600 jobs in combined, the big banks, last year. Does 2026 look like that as well? I think that was the most since 2016.
I don't have a view on Wall Street overall and its headcount. I understand our headcount plan.
Yeah.
And all we've said publicly is it's probably a little bit more constrained in 26 because we see opportunities for efficiency and we're trying to deploy those. But ultimately, we've also said those efficiency opportunities give us more of an opportunity to invest in parts of our business where we can scale growth. And some of that growth scales with additional headcount. I point to our wealth management business, which scales with people all over the world.
That was Goldman Sachs Chairman and CEO David Solomon speaking exclusively with Stephen Engel. Now to other top stories trending on the terminal this morning. PIMCO is standing by its conviction in Japan's 30-year government bonds despite last week's rout. Fears of fiscal excess by Prime Minister Sanae Takaichi's administration wiped out $41 billion from the bond market and triggered a sell-off elsewhere. Breitling's CEO expects the US to cut tariffs on Swiss watches. The watch industry was jolted in July when President Trump imposed tariffs of as much as 39% on Swiss imports. That tariff was later cut to 15%. Breitling's CEO says the levy makes no sense given Swiss watchmakers do not compete with US domestic production. And the largest grid operator in the United States was granted authority to divert power meant for data centers to households, hospitals and other customers. PJM, which serves more than 67 million people from Chicago to Virginia, sought federal approval to stave off the potential need to impose rolling blackouts. Coming up, a strategy shift. President Trump's border czar, Tom Homan, set to meet with the mayor of Minneapolis. More on that next. This is Bloomberg. This is Bloomberg Brief. I'm Bonnie Quinn in New York. U.S. Border Patrol Commander Greg Bovino is said to be leaving the city of Minneapolis over the recent killings of 2 U.S. citizens by federal agents. This as President Trump signals a strategy shift in his deportation drive. Joining us now from Washington is Jonathan Tamari of Bloomberg Government. Jonathan, pressure was ramping up. We even had CEOs in Minneapolis writing a letter to Trump saying, de-escalation should be the priority. Is that what prompted Trump to finally do this, or is it something a little bit more practical, like polling numbers?
I mean, it's probably a combination of these things. I mean, having these 2 shootings in such close proximity, and in this second instance, having members of his administration make some claims and statements that were just blatantly false about it, I think has turned a lot of public opinion against the president. I think even he and some of his advisors think that this is not going the way that they want it to go. Many voters are saying that it's not what they expected, even though they want border enforcement. They strongly disagree with the tactics that are playing out here. And you're even seeing some concerns from Senate Republicans. So I think all of that combination is affecting the president and causing him to have to change tack, which is something he almost never does.
Tom Homan, borders are, in Minneapolis, has been sent there by President Trump. Obviously, Kristi Noem is, the person that's been in charge of this. Does she keep her job, Jonathan? She's obviously going to be testifying in front of many committees over the next several weeks. But does Trump keep her?
That is the big question right now, I think. That's what a lot of people in Washington are watching. Senators are certainly starting to zero in on her, calling her to come and testify, raising concerns about the way she presented the evidence that turned out to be not true immediately after this second shooting this weekend. So I think we're going to be watching. She's certainly, at a minimum, being kind of downplayed and replaced as the face of this operation by Tom Homan. Whether they go a step further, I think we'll find out in the coming weeks.
Now, we do have a fresh tariff threat today as well. Trump promising South Korea is going to raise tariffs on their goods by 25%. I mean, do we need to take this seriously given that recent threats haven't come to pass?
Well, I think you have to always take Trump seriously because sometimes he certainly does follow through on things that he says that people say, oh, he'll never go and do that, and he actually does. People didn't think he was serious about trying to take Greenland, and clearly he showed that he was. But as you point out, our colleagues at Bloomberg have crunched numbers. Something like 27% of the tariffs he has threatened have actually been fully implemented. And even then, many of those have been scaled back eventually. So I think you do have to take it with a grain of salt, but know that there are times that Trump does push the button. It makes him a very unpredictable actor, which I think he likes, and many people on the other side of the table do not.
Yeah, you can't completely discount anything, right? Jonathan, thank you so much. Jonathan Tamari of Bloomberg Government in Washington. On the East Coast, travellers bracing for further disruptions from another winter storm later this week, which airlines are still cutting back flights. Bloomberg's Benedict Camel joins us now for more. So we're in the middle of earnings season for airlines, but we have all these flight cuts. Benny, how are airlines coping?
Well, today looks a little bit better. We sort of had the peak of disruption yesterday with more than 6,000 cancelled flights. If you compare that to today, we're just north of 1,000 at this point, still quite a bit. The hotbed being still on the East Coast, so places like JFK, Boston, and DC and so on are impacted. It's less the snow at this point and more the freeze. So you have a lot of de-icing activity on the ground. That's delaying operations and actually cancelling some flights. But it appears we are through the worst at this moment. We heard from Sean Duffy, the Transport Secretary, yesterday saying that he hopes things to be back to normal by tomorrow. So we'll see about that. There'll probably be some commentary today. We get earnings from American Airlines, we get earnings from JetBlue, and those are two of the airlines that were most impacted by this. Obviously, that won't feed into the earnings because that came after the numbers, the storm, but still, there'll probably be some commentary on how they dealt with the operations and what kind of lessons they learned.
Yeah, absolutely. And it was interesting to hear United Airlines talk about geopolitical disruptions hurting and their outlook for this year being that that will happen more and more, right? Because United had a fantastic year in the end. They're taking delivery of more than 120 planes this year.
That's sort of been the theme of the earnings so far. If you look at airlines that have reported, Delta, United, Alaska, they all had very good numbers, but they probably also learned a lesson from last year where they went into the year feeling really good and then things sort of fell apart rather quickly amid the tariffs and the first sort of geopolitical dislocations. So this year, they're going into 2026 with a more sort of cautious mind frame. They are aware of what's happening with Europe and the US and the dislocations there over Greenland that we just heard. So we might get similar commentary today from American.
And from Boeing as well. Benny, thank you so much. Benedict Camel, thank you. Coming up, we'll get you set up for your trading day with economic data on deck. This is Bloomberg. Now a look at what's ahead today. First up, earnings from Boeing, American Airlines, UPS, United Health just out, beating on the bottom line, and General Motors also coming out a little bit today. Don't miss our interview, by the way, with GM CEO Mary Barra at 7:30 a.m. Eastern. Plus, data-wise, we get consumer confidence from the Conference Board. That comes out at 10 a.m. Eastern. So once again, let's take a look at the macro environment. We have futures pointed higher as we ramp up earnings week. We have the dollar index sort of bouncing around its lows, so not a huge comeback in that story, but at least some stabilization, particularly with the yen. The US 10-year yield at 4.22. We have the 2-year yield still at 3.58 as the FOMC begins its meeting. And once again, I just want to point to United Health earnings just out, beating on the bottom line. It's been a tough few sessions, though, for health insurers. That is it for Bloomberg Brief. Surveillance is next.